We're going to talk about the real estate market in this video, and I'm going to take a little bit different spin on it than a lot of people that are talking about a potential real estate crash. In real estate right now, what people are saying is that there's going to be no way there can be a real estate crash because, look at the number of people that are, the lack of housing that we have compared to how many people actually need homes. So there's a big supply and demand issue when it comes to real estate. So a lot of the data is specifically pointing to that there cannot be a real estate crash, with inflation numbers going up. So people are assuming that, that's going to affect real estate as well, where inflation is going to keep pushing real estate prices up. Same with the supply demand, where there's low supply of real estate and a high demand for real estate or high need for real estate. So all these things are kind of pointing towards, hey, real estate values are going to go up. Well, we're going to take a little bit different spin here. We're going to step back from the data and kind of look at the psychology of what's happening. And I think this is a very different way to look at things and to understand investments. I could be wrong here, but my approach has always been looking at investments from a personal psychological perspective, because ultimately humans are what drive prices. And if you understand humans and how humans react to things, I think you could reasonably assume how investments are going to do. Granted, there's no accuracy per se here. There's going to be a lot of assumptions and a lot of different variables, and humans are very hard to predict. But let me paint the story for you. So let's say that we're in the situation we're in now. Housing prices are at the most unaffordable that they've pretty much ever been. Houses were more easily affordable in the Great Depression. So that paints a picture for you on the affordability right now. So right now, people can't afford houses. So then let's add in inflation. So now people can't afford gas, they can't afford groceries, and they can't afford the house they live in. And a lot of people anecdotally have been, basically funding their house purchase by selling things like stocks or company stocks, because company stocks are at all-time high valuations. So you're getting a lot of extra money from company stocks. So you have these different variables, right? So what can we then start assuming? Well, housing or things like food and gas are getting more expensive. So people's daily take home is going to get tighter and tighter and tighter. So that house is going to feel less and less affordable each day, right? So then even if you have low mortgage interest, so then you add in stock prices go down. Well, now people have less stock in things. They're going to feel that they are, less prepared for what's going on in the world. And so therefore they're going to start panicking a little bit. So if you have a stock pullback, which we're already in the midst of, plus rising cost of living, which we're already in the middle of, there's speculation that taxes are going to increase. So again, that's going to eat away at the paycheck of Americans. So all these different variables are basically meaning that affordability of homes are going to get tighter and tighter and tighter, right? So then what happens when people's pocket gets tighter and tighter and tighter? Well, eventually the pain gets real and they start to make decisions, right? So what's the decision that a person with a tight pocket would do? They see a lot of equity in their home. They may say, all right, let's downsize, or let's capture some of that equity, or I can no longer afford this equity, so let's just downsize. So you're going to have some people that start making those decisions. They're going to sell their home, capture that equity, but because houses aren't going for the same prices potentially, they may be willing to sell that home at a lower price to capture that value. Well, then that resets the comps, the comparables of what the next home sold for, right? So then you may see a couple people do that, sell for lower than the market, just because they need to recapture some of that equity, or because they want to recapture some of that equity to feel a little bit more comfortable, right? Well, if other people then start seeing they may not be in as much pain from a day-to-day paycheck perspective, but they may be in pain or may be in close enough pain where they see the equity of their housing market dropping. They may say, wow, I have $400,000 in equity. The housing market's dropping. Maybe I should just go ahead and sell, just be on the safe side before it becomes a ripple effect. Well, then people start selling that. Then it does become a ripple effect because people start seeing their equity dropping. That's where the pain really starts getting real for people, because they already can't afford it. Plus they see their equity dropping in their home. that's when people start making decisions and start acting irrationally. So it's entirely possible to have a real estate market drop, even if there's things like inflation and other supply demand issues, just purely based on those type of psychological factors. And I have even brought in the idea that if we're pushing towards a recession, which we likely are, and in fact, I think we already are in one, even though the numbers don't necessarily say that per se. If people start losing their jobs, then that affordability gets really, really tight. And that's when this just, explodes in the downward direction. And like that's similar to what we saw in 2008 was we started hitting a recession and those numbers started plummeting. So I think we're going to see a real estate pullback. Do I think it's going to be necessarily a sustained one? Not necessarily. I mean, 5-10 years, probably. But, to the data's point, is there a supply demand, long term weighting towards real estate going up? Yes, there is. In the short term, I don't think so. I think the demand, the supply issues, you're going to see basically demand drop significantly because of affordability. You're going to see demand for lower cost housing increase, which is going to basically drive the prices down. Long term, I think they'll go up because I think interest rates are going to eventually have to come back down. All these different variables, I think, still support real estate long term. But I think in the next 5-10 years, especially in highly appreciated cities like Austin, San Francisco, New York, I think we're going to see some pretty big pain with affordability and with housing prices over the next, call it 5-10 years. Hopefully you found this valuable. I know it's a little bit of a different take on real estate and how to think through some of these investments and through some of these patterns. But I think pulling in the human element is a super important thing to do when considering investments. Cheers.